A seismic shift is occurring on our northern border, one that is sending ripples through the entire North American energy landscape. For decades, the United States and Canada have enjoyed a stable, mutually beneficial energy partnership, with resources flowing freely across the border. But now, a series of dramatic changes is rewriting the rules of this relationship, and the effects are being felt in homes and businesses on both sides. From the price you pay at the pump to the cost of keeping the lights on, these changes are impacting gasoline prices and electricity costs in ways that few could have predicted just a few years ago. Families are noticing higher bills, and businesses are struggling to adapt to the new reality of energy uncertainty. The US and Canada have long shared a deep energy connection, with millions of barrels of oil, vast quantities of natural gas, and gigawatts of electricity crossing the border every day. This interdependence has been a cornerstone of economic growth and energy security for both nations. But new pipelines, shifting political priorities, and heated trade disputes are now altering this dynamic. Construction projects spark both hope and controversy, while protests and policy debates highlight the growing tension over how energy should be produced, transported, and traded. In March 2025, the US imposed a sweeping 25% tariff on Canadian imports, including key energy products. This move, intended to protect American industries, has instead sparked economic tension and uncertainty, with both governments scrambling to respond. Canada, in response, considered cutting off electricity exports to the US, escalating the situation and raising the stakes for millions of consumers and businesses. The threat of losing access to clean, affordable Canadian hydroelectricity has sent shockwaves through American energy markets. Meanwhile, Canada has launched the Trans Mountain Expansion Pipeline, a massive infrastructure project designed to open new export routes to Asia. By reducing its reliance on the US as its primary energy customer, Canada hopes to diversify its markets and strengthen its own economic position. This strategic move is already impacting American energy security and market stability. Traders are watching nervously as supply chains shift, and US storage facilities face new challenges in balancing supply and demand. To make matters even more complex, a severe drought in Canada has reduced water levels at key hydroelectric dams, limiting power generation and increasing their reliance on electricity imports from the US. This environmental crisis is adding another layer of uncertainty to an already volatile situation. The era of predictable, low-cost energy from Canada may be ending, replaced by a new age of uncertainty, higher prices, and shifting alliances. As families and businesses brace for what comes next, the future of North American energy is being rewritten before our eyes. The Trans Mountain Expansion Pipeline, or TMX, stands as a monumental project that is fundamentally reshaping the landscape of North American energy. Stretching across rugged mountains, dense forests, and vast prairies, this pipeline is more than just a feat of engineering. It's a symbol of ambition and transformation for Canada's energy sector. Completed in 2024, after years of planning, debate, and construction, TMX nearly triples the amount of oil that can be transported from Alberta's oil sands to the Pacific coast. This dramatic increase in capacity opens up new opportunities for Canadian oil producers, allowing them to reach lucrative Asian markets for the first time on a large scale. With tankers now able to load directly from the West Coast, Canada is no longer limited to a single customer. For decades, the vast majority of Canadian oil was shipped south to refineries in the United States, where American buyers held significant leverage over pricing. This dependency often meant Canadian producers received less for their oil compared to global benchmarks. By providing a direct route to international markets, TMX is a strategic pivot that reduces Canada's reliance on US refineries and gives Canadian oil a stronger position on the world stage. The journey to completion was anything but smooth. TMX faced fierce opposition from environmental groups, indigenous communities, and local governments concerned about the risks of oil spills and the impact on climate change. Legal battles played out in courtrooms, and public protests made headlines across the country. Yet, despite these challenges, the Canadian government pressed forward, arguing that the pipeline was essential for the nation's economic future and energy independence. Now major oil producers like Cenovus and Suncor stand to benefit from direct access to global markets. With the ability to export oil to Asia and beyond, these companies are better positioned to compete internationally and potentially close the persistent price gap with US benchmarks. Investors and industry leaders are watching closely, as TMX could reshape the financial landscape for Canadian energy companies. For Canada, the Trans Mountain expansion is more than just a pipeline. It's a declaration of economic independence and a bold bet on the future of global energy demand. As the world's appetite for energy continues to evolve, TMX positions Canada as a key player, ready to meet new challenges and seize emerging opportunities on the international stage. Canada's quest for new oil markets is driven by a combination of strategic security, economic opportunity, and national interest. For decades, the United States has been the primary destination for Canadian oil exports, creating a relationship that is both lucrative and at times precarious. While this close partnership has brought prosperity, it has also left Canada vulnerable to the shifting tides of American politics and policy decisions. As global energy dynamics evolve, Canada recognizes the importance of diversifying its customer base to ensure long-term stability and growth. Relying solely on the U.S. for energy exports poses significant risks. Political shifts, such as changes in administration or new regulations, can have immediate and far-reaching impacts on the Canadian economy. For example, a single policy decision in Washington can disrupt billions of dollars in trade, affecting jobs and government revenues across Canada. This dependency has prompted Canadian leaders and industry experts to seek alternatives that can buffer the nation from external shocks and unpredictable policy changes. The cancellation of the Keystone XL pipeline project was a wake-up call for Canada. Years of planning and investment were undone by a single executive order, underscoring just how fragile the relationship can be when it comes to cross-border energy infrastructure. The setback highlighted the urgent need for Canada to diversify its export routes and reduce its reliance on a single market, no matter how friendly or familiar. In response, Canada has invested heavily in projects like the Trans Mountain expansion, or TMX pipeline. This critical infrastructure allows Canadian oil to reach the Pacific coast, opening up access to global markets beyond North America. By connecting to international shipping routes, Canada can now sell its oil to a wider range of buyers, increasing competition and aiming for fairer, more competitive pricing for its resources. With energy demand in Asia rising rapidly, Canada is positioning itself as a reliable supplier to some of the world's fastest-growing economies, including China and India. These countries are hungry for energy to fuel their industrial expansion and urbanization. By tapping into these markets, Canada not only finds new customers but also strengthens its role as a global energy player capable of meeting the needs of diverse economies. This strategy of diversification is about more than just economics. It's about managing risk. By reducing dependence on a single market, Canada can better withstand political uncertainties, such as the looming threat of new U.S. tariffs in 2025. Expanding trade with Asia and other regions helps insulate the Canadian economy from sudden policy changes south of the border, ensuring a more stable future for Canadian workers and businesses. By strengthening trade ties with Asia and other global partners, Canada gains not only economic resilience, but also greater leverage on the world stage. Diversification empowers Canada to shape its own destiny, secure better deals for its resources, and build a more prosperous, independent future. Canada's TMX pipeline impacts U.S. refineries, especially in the Midwest and Great Lakes. These refineries, designed for Canadian heavy crude, face a new competitive landscape as oil flows west to Asia. U.S. refineries must now compete with international buyers, likely raising costs. This shift could increase gasoline prices, as refineries pass on higher crude costs to consumers. The era of cheap Canadian crude is ending, forcing refineries to adapt. They may need to source oil from Latin America or the Middle East, requiring costly adjustments. This transition creates uncertainty and potential volatility in the American energy sector. U.S.-Canada energy relations are strained by trade disputes and tariffs. In March 2025, the U.S. imposed a 25% tariff on Canadian imports, causing economic chaos. Canada retaliated by threatening to cut electricity exports, leveraging its energy sector. The U.S. and Canada share a complex energy grid, with regions like the Northeast heavily reliant on Canadian power. A halt in exports could lead to soaring electricity prices and reliability issues. The standoff underscores the fragility of this cross-border relationship, turning energy into a political weapon. A severe drought has reversed the historic U.S.-Canada electricity flow. Canada, once a powerhouse of exports, now imports U.S. electricity due to hydropower shortfalls. The drought has crippled Canadian hydropower, forcing reliance on American energy. U.S. electricity exports to Canada surged, altering trade balances and impacting economies. This shift highlights the interconnectedness of the North American grid and the impact of climate change on trade. The drought has created a crisis for Canada's energy sector, particularly in British Columbia and Quebec. BC Hydro and Hydro-Quebec face significant production drops, impacting exports to the U.S. Canadian utilities now import U.S. electricity, affecting finances and environmental goals. This crisis reveals the vulnerability of relying on a single energy source amid climate change. Canadian consumers face higher electricity bills as utilities pass on costs. Canada's oil pivot and trade tensions signal higher energy costs for Americans. U.S. refineries will pay more for Canadian crude, raising gasoline prices. An energy trade war could spike electricity costs in the Northeast. The reversal in electricity flow increases demand on the U.S. grid, driving up prices. The stable energy relationship with Canada is fraying, leading to volatility and higher costs. Americans must prepare for a future of less predictable energy expenses. The U.S.-Canada energy relationship faces unprecedented uncertainty. Canada's TMX pipeline alters supply dynamics, raising crude oil costs. Trade tensions introduce political risks, threatening grid reliability. The climate-driven drought highlights the need for resilient energy systems. Both nations must invest in diverse energy technologies to adapt. The era of taking energy stability for granted is over, demanding attention and action.